Hey everyone, this is Jenny Bayless, and I'm here with Chris Lopez today. Chris, how are you doing?
Doing great. I am looking forward to talking about some cost segregation.
Me too. So just a quick intro to our guest. I'm very excited to have her on today. Bonnie Griffin Kaake. We met at a Bigger Pockets meetup a few months ago, and she wowed me with her cost segregation knowledge. She works for Cost Segregation Services. And Bonnie, if you could you give a little bit about your background in real estate and then how you transitioned to being a cost seg expert?
Sure can. I was a commercial real estate broker and licensed, but I'm currently inactive. I don't compete with real estate brokers at this time because a lot of them learn about cost segregation through me and will send me people that need some extra cash flow. I also have invested in commercial real estate, have a couple of residential rentals over the years. And now I have stopped investing, have liquidated a lot of properties, and I'm really enjoying helping people understand how they can leverage cost segregation and the other tax benefits that are available to them so they can stop paying so much in taxes. There are just too many benefits out there, and I see too many leaving money on the table that they could leverage and use elsewhere. Okay. So cost segregation, we have training meetings twice a week, and we have to go through extensive training prior to even being able to talk about it. So we're usually pretty good, and I also teach CPE, continuing education classes for CPAs, because I find that maybe 1 out of 10 really has enough background to understand cost segregation. So even the people out there listening to this podcast, don't feel bad if you don't know. Just ask questions, because if I don't have an answer to them for you, I know where to get them. You know, we've been in business a long time, more than any other company. And after doing 35,000 studies, we've probably done it before. Okay. So you just ask.
Yeah. So if you could tell us a little bit, I don't know, maybe we should back up and just quickly talk about depreciation and how it relates to real estate. And then we'll go into defining what a cost segregation study is. So could you tell everyone a little bit about what depreciation is, just in terms of, the non-cash expense or phantom expense? You'll hear people talk about it.
Mm-hmm. Well, what it is basically in real estate, you depreciate, or CPAs will depreciate the property over 27 and a half or 39 years, depending upon whether it's a residential property or whether it's a commercial, what's considered a commercial property. And when I refer to residential, I'm talking about a single family home, a condo, multifamily apartment complexes. They all come under the category of residential, with one exception, and that's the short-term rentals. But we'll get into that a little bit later. Short-term rentals are a special category and has some little intricacies along with that are good to know. The last thing we want to do is trigger audits, right? I don't like auditors in the past, and it's not a pleasant experience. Okay. So cost segregation really is about taking that 27 and a half years or 39 years that a CPA will, or a tax professional will put on straight line depreciation, which means that they don't put property in there. You can't depreciate property, the land itself, but you can depreciate that building on straight line over 27 and a half or 39, which means that each year you get 1/27th or 1/39th of the depreciation each year that you can take for taxes. Now, with cost segregation, you get to, again, you can't depreciate the land, but you can take that 27 and a half years or 39 years and get the depreciation for the building minus structure right up front. And it usually represents anywhere between 25 and 30% of what you paid for that building. That's pretty substantial. And as far as cash flow, depending upon your tax rate, you can probably expect about maybe 6 to 8% of what you bought that building for in taxes you don't have to pay the first year right now. That's going to change a little bit, drops each year, but we can go into that too later if you'd like.
Yeah, I think that the concept of depreciation is one that's very powerful, but often overlooked by investors. And, just to kind of, reinforce that idea a little bit, like the IRS requires that you take depreciation. It's not an option. So when you sell the property, that could have some implications as well. But then, just the fact that depreciation is kind of the IRS's gimme to an investor, saying that your property is going to wear down over time. And it doesn't matter if your property's 200 years old when you buy it. They pretend that it's going to wear equally from the day you buy it onward. So it's just kind of an interesting little concept that I think is often overlooked, but as you're going to show us today, is incredibly powerful for people's bottom lines. So leading us into what is a cost segregation study.
Okay, a cost segregation study is taking the building purchase price minus land, okay, and then we separate that by segregating what is tangible property versus what's structural. The structural property itself has to go the 27 and a half or 39 years. Okay, that's ongoing, even if you do cost segregation. But the things that we can expedite that are considered tangible property can be taken right now 100% in the first year through 2022. Okay. Now, if you've bought the property between 2017 and 2022, you're eligible for 100% depreciation that you can get up front. Now, starting in 2023, that jumps down to 80%, but you still can expedite the rest of it. So it's not a big deal. As a matter of fact, before we got the 100% depreciation, before 2017, it was 50%. And long before that, we had no bonus depreciation. So it's really not a big thing. You still want to do cost segregation because that's going to expedite what you can take as far as tax benefits. Okay.
Yeah, great. So bonus depreciation, can we step back and define that for our audience a little bit?
Sure. Okay. Bonus is taking what is a 5-year, 7-year, and 15 years, normal depreciation, with expediting it. And we can take all of that in the first year now. Or next year, we'll be able to take 80% of that in the first year. And the balance would go 5, 7, or 15, and the 27 and a half or 39. And I know it sounds complicated, but once you get a handle on it, it's kind of a no-brainer. The American Institute of CPAs and the Journal of Accountancy both recommend cost segregation be done. There are many methods of doing it, but I would say that if you own a property over $250,000, get an engineering-based cost segregation study. That is your best chance of eliminating the possibility or greatly reducing the possibility of an audit. In our over 20 years of being in service, we've never triggered an audit and we've never had a study overturned. I don't know of another company that can claim that, but I think that investors need to know that there is so much information out there about cost segregation that may not be in their best interest if they're strictly looking at the cost. So I think it's really important that they do a little research about whatever company or method they're going to use if they really want to save themselves from an IRS audit, especially with these new 87,000 auditors coming on board, even though about 55,000 of those are replacing retiring auditors. The rest of them are really going to start focusing on depreciation schedules, we've been told, because it's low-hanging fruit for the IRS because so many of them are not being done correctly.
So you're referencing an engineering study, and last year it's the first time I personally did a cost segregation study for any of my assets that I own, and I spent some time, learning and debating between there's a lot of like DIY, the do-it-yourself ones, versus an engineering study, and I looked at the DIY ones because they're attractive. Hey, they're simple, they're less expensive. And then I got 2 minutes into it, asked me a bunch of information. I was like, yeah, I can't handle this. And I was like, I don't want to worry about saving, a couple $100 or $1,000 or $2,000 and potentially have like a bigger headache with the IRS or screw up a $300,000, depreciation reschedule. So when you're saying like a engineering study, you're referring to hiring out a firm like yours versus do like a DIY study, correct?
Yes.
Yeah.
Yes.
And I definitely recommend people always hire professionals, especially for complicated things like this. This is one area I personally feel comfortable on saving a few dollars on. So I hired professionals.
Yes. Yes. Because those few dollars you save, if you have an auditor sitting in your office for a few days or more, suddenly that doesn't look like it's so attractive. Right? Engineering-based study is the IRS's preferred methodology. And that's also why there are so few audits of those studies, because an auditor can't do as deep an analysis of the property as we do with an engineering-based study. And it also requires an engineering-based study have an on-site visit. And it doesn't mean just the outside of the building, okay? It also is inside and outside, because we need to be able to verify the numbers we're coming up with. Because a lot of the percentage of what we get to depreciate upfront is inside. That's tangible property. It's not just the driveway and the trees outside. Okay. So, if we can verify it, you and I both know that the IRS is not going to go visit the property to audit your tax return.
No, and something I'm curious. I want to clarify this because you said they're for an engineering-based study. Like when I submit my tax returns, do they know if it was an engineering study versus a DIY, or is that once they start the audit and they say, oh, this is a DIY versus engineering?
Well, our documentation goes to the CPA or tax professional, and they attach the information on that to the tax filing. And it will also have the name of the company that's doing the cost segregation with it. That's my understanding. Now, I'm not a CPA, but the CPAs feel very comfortable in working with, an engineering-based study versus just filing something that's an online, generic kind of study.
So how would you recommend that investors go about determining whether a cost segregation study is worthwhile? So if we're speaking only about an engineering-based study, for example, would you say that there's a certain property price threshold or an investor profile that does or does not lend itself to be cost beneficial in that case, since engineering-based studies are not cheap by any means, but in a lot of cases they definitely pay for themselves very quickly. So,
but I would say that an engineering-based study is viable on properties starting at around 250,000. A lot of companies will only go starting at 1 million, but why not the smaller taxpayer as well? Taking a look at something that's going to keep them out of an auditor's, close-up view of their tax returns. So in years past, cost seg studies used to be very expensive, but they have really come down in price because more and more of them are actually being done. So there are some reasons that you wouldn't want to do a cost segregation study. And those are things like you pay no taxes. If you're a nonprofit and you don't pay taxes, a cost segregation study is going to do you no good. Okay. So if you're going to sell the property within 2 years, it's another good reason it's not going to be worth doing the study, because the cost of the study, you want to make sure that you start getting a return on that investment in the study. And that takes about 2 to 3 years to get that return and start looking at, some profitability, with that study. Also, you can only do a study on property that's occupied. So that's another little tricky spot. If you buy a building that is not occupied, you can't do a cost segregation study until it is occupied or at least listed for rent, whether it's a residential or whether it's a commercial. That doesn't mean somebody has to be in the building. It means that you need to be actively pursuing someone to occupy that building. So what I tell people is, if you buy a building and you plan on doing some major renovations, do the cost seg now. Do the major renovations in the year following, because you can't take major renovations, expedited depreciation in that first year, because the way the IRS looks at it is that was already bad in the property to begin with. So it's not something that happened during your ownership. It happened prior to, and you bought it that way.
Is that what the IRS calls placed in service dates, and for those guidelines right there?
Yes.
Okay.
Yeah. And now placed in service is a little tricky, because a lot of people will buy a commercial property and the owner has an agreement with the buyer to stay in that property for a while. Could be a week, could be 6 months, who knows? They're releasing it back, or it's part of their agreement. That means that property is already occupied. But the best tax benefit comes if you do the renovations that you have to do in the first year, especially later in fourth quarter of the year. Do the minor renovations now, do the improvements in the year following. Because there's another thing called partial asset disposition, which can be taken advantage of. So if you're doing a cost segregation in 1 year, and we outline, okay, here as an example, here's what those refrigerators and stoves and appliances are worth right now. Next year, you decide you're going to change them out. Well, you've already paid for in the purchase price the ones you bought the property and it was, in that property at that time. The second year, you can actually expense those things off your depreciation schedule when you're replacing it with the new ones. But if you don't know that, then you're going to continue depreciating not only the old ones, but also the new ones over the next 27 and a half years. So, and it's missed so much, but the key here is that it must be done in it must be done in the year that you do those renovations. So if you wait 3 years, a lot of people do it, they don't know any better. They say, a couple of years ago, I did all these renovations. Sorry, it's too late.
So I would like, because we're giving a lot of very good technical stuff. I would like to, if we could actually give an example, just so some rough numbers, because when I started learning about cost segregation, bonus depreciation, all of this, it took me a few podcast episodes and a few Google searches to really start wrapping my head around it. Mm-hmm. And one thing that's helped me was just kind of getting some just some rough numbers. Can you walk us through just a very high level, rough example of a Colorado property, $500,000 or maybe $1 million property? Kind of walk us through the math of, hey, here's normal straight line 27.5 depreciation versus, hey, if we do cost seg and bonus, how that all works out?
Yeah, it is different for each property. And that's a little technicality, because a lot of people say, well, gee, how much am I going to be able to save on taxes? Or what can I depreciate right up front? And there are so many variables. That's why it's best to get an estimate first. And estimates are free, whether they're done through our company, whether it's done from another engineering-based cost seg company. They don't charge anything to do these. So look at that to determine your specific property. Let me give you an example. Okay. Let's see. I had a condo, $500,000 condo. Here in Colorado, a lot of times the land is not included, but there are other situations where they include land. So that $500,000 property, depending upon where it is, will have a different amount of savings. Some of them up in ski areas, the land itself may be 60% of the value you bought it for. So you don't have that 60% to depreciate. So I can't really say, okay, you're going to get 6% of that 500,000 in cash flow, or 8% in cash flow, taxes you don't have to pay, because the land can't be depreciated.
Right, I get that, but just more from like a conceptual perspective, just because like, you know, I understand the nuances for that, but like when I did my own, I really understood the numbers of how much it front load depreciation, like it just floored me. I was like, wow, every client out there who qualifies for it, you know, based on properties and, you know, makes sense for their taxes and all that, like, holy smokes, you got to do it. Because I've got the biggest refund check ever in my entire life this year. And it blew my mind.
Yeah. Okay. Well, let's say, to give you an example here, let's say that without land, the property is worth $500,000.
Okay.
Okay. So if we take 30% of that is what we can probably depreciate up front, that's $150,000.
Through bonus depreciation,
Right.
hypothetically. Okay.
Mm-hmm. But depending upon your tax rate, it depends on how much of that you can take. So if we take $150,000 up front in tangible property we can depreciate, let's say your tax rate is, what do we want to say, 30%?
Yeah, say 30%.
Okay. 30%. That means you've got $45,000 worth of taxes you do not have to pay this year. $45,000. That is a lot of money.
And comparing, you said 150 would be first year depreciation. If we were to just straight line it, that 500 with no land over 27 and a half, we're talking 18,000.
That's right.
So that's a pretty significant difference, even when you apply your tax rate to it. And again, these are all just hypothetical numbers, but I think that it shows the difference between being able to accelerate versus take the normal depreciation schedule on that.
Yep.
And can you go into a little bit of an explanation? So Chris, you're a real estate professional in the eyes of the IRS, right, Chris?
Correct.
Yeah. So he gets different benefits than someone who's in a W-2 job as a lawyer, for instance. Can you explain a little bit about that?
Sure. As a real estate professional, you can take the depreciation that you get on one property, and you can use that even against a W-2 income or other income that you have. So it's pretty lucrative. But that doesn't mean that cost segregation isn't valuable. As a matter of fact, one of the big things that people miss is if it's an owner-occupied building. Let's say you're an insurance company and you bought a little building to operate your insurance practice out of. If you don't do what's called grouping, the first year you buy that property, you can't use it as active. But if you group it, in other words, the building and your business have the same owners, then you can actually group that, and any big depreciation that we can give you on cost segregation, you can use against your income. Doctors, lawyers, people who operate their practice out of the building, this is key. And I see, I hate to say it, but well over 50% of people don't catch that, because tax professionals, this is not their area of expertise. Real estate is not. They know it, and that's why they use outsourced experts in this area. So as far as a home, it's passive unless you're, like Chris, a real estate professional, which means that the depreciation we can take on that property up front can only be used against the income from that property. It can't be used against your W-2 income or anything else. It's just that property. Unless you own a lot of passive income properties, then you can do what's called aggregating. In other words, they kind of group them together, and then you can use losses on one against the income on another. Another thing that I think is really important is that short-term rentals are often done incorrectly, and that can be a trigger down the road for the IRS. So if you own a short-term rental, you want to make sure that one thing, they have to be depreciated over 39 years, not 27 and a half. It's not considered residential. It's a business, like a hotel.
Oh, so even if you, let's just say, go buy a single family home in Arvada, which is a very, common market for Airbnbs right now. I go buy a $500,000 single home on Arvada, investment property, Airbnb it. I have to depreciate over 39 years, even though it's a residential structure. Since it operates an Airbnb, you're saying that now reclassifies it as a commercial property?
That's right.
Oh, interesting.
Yes. And I would say a lot of the depreciation schedules that I see are coming in with depreciations of 27 and a half years on these, and they should be 39.
Well,
okay.
If I own Airbnbs, I'm sure I would have classified them as 27.5, but I don't. But yeah, I had no clue on that. Because I just assumed no matter what, it was what the structure was, but I guess it's the use of it as well.
That's right. So it's one of those little nuances that, again, if you don't have a professional that understands commercial real estate and the depreciation little intricacies, you can miss that.
Well, let me ask you this, because I was actually at an event. It was a group of medical doctors, and a lot of times, they're high income, busy people, and it's not uncommon for one of the spouses is the doctor, and the other spouses, they don't have as demanding job as their spouse does in the medical field, but they go out there and they're the ones actually running their portfolios, running the properties, and they go out there and reach that real estate professional status to help offset the medical doctor's W-2 income.
Yes.
But one of the people I was talking to this weekend filled me in, and I just learned this, and I want you to clarify this for me, saying if it's an Airbnb property, that's a totally different set of hours and metrics to go out there and qualify that properly. Like it's 100 hours, they said, or it has to be the most you have to be the most active person at property.
That's right.
I need all the details. Obviously, you know them. Could you clarify them for me and educate the rest of the audience?
Yes, Airbnbs are great for people who live near the property that's an Airbnb. Because let's say you buy a property in Florida and you live here in Colorado and you make that an Airbnb, I don't think the IRS is going to believe that you're actively participating in that property. Right?
I'm not cleaning it every 3 days. Yeah.
No, you're not going down there every 3 days to clean it and get it ready for the next occupant. So therefore, that property is not going to be an active property from the perspective of material participation. Okay. But it is considered a 39-year property. That doesn't change. Okay. And it will still be a passive property unless you're a real estate professional. If you're a real estate professional, then even though you're not participating as much, most likely you can still take that as an active property because it's like a hotel. It's a business. Grouping those passive properties is important. Grouping probably is not all that important when you're a real estate professional because you're going to designate whether you're active in that property or not each year on your schedule. And because you can be active in a property one year and inactive in another. So hopefully that kind of makes sense to you. The other issue on a short-term rental is that the furniture and furnishings in that property can also be depreciated right up front.
Yeah, that's fascinating because we always talk about Airbnbs or businesses when we talk with clients. I want to, Airbnbs from cash flow are very, very attractive.
Oh,
They do take more management either through the owner or the owner finding and managing a active Airbnb property manager. So I think all these nuances are fascinating and really want to highlight because we have quite a few investors now in both Springs and Denver, some actually starting in Pueblo now getting into that short-term rental market. Now, I'm going to put you on the spot. What about medium-term rentals? We have a lot of clients who pivoted towards medium-term rentals as laws have changed or they've kind of found the sweet spot. We're like, hey, I can't self-manage Airbnb, but they can self-manage a medium-term rental. Do medium-term rentals, aka corporate rentals, aka traveling nurse rentals, do those qualify as a business under the same short-term rental laws, or are they long-term rentals or a whole separate category?
They're concerned residential rentals if it's 30 days or more.
So that's the key. 30 days or more is the distinguishing mark. Okay.
Yes.
That's good because that's how they qualify from a statutory standpoint as well for, local ordinances. So I'm glad that the rules kind of are in line there.
I think that's one of the first few times actually different rules actually match up and make sense. Like, holy moly, government, way to go.
Yeah, and the short-term rentals are also considered residential rentals rather than a business. So, I don't know, did I say short-term? I meant medium-term, the 30 days or more. Okay,
Mm-hmm.
30 days or more, they're considered depreciated over 27 and a half years, not 39. So those little nuances are important when you're doing your taxes to make sure you've got the right professional working with you that understands these little differences to keep you out of trouble down the road.
Absolutely. Because I think it's key to not only pick the right engineering-based study company to, substantiate the report that's being produced, but then the actual application of the report is a whole other layer that it's very important to have your CPA on your side and bringing the two together to figure out what is allowable and the most advantageous for that particular investor. Because I think something that we've just talked about during this conversation is there are so many different nuances within the properties themselves, but then also that particular investor's personal situation or, work situation that could alter things as well. So, just because it's really beneficial for Chris to be able to do a cost seg study based on him being, real estate professional status. His wife has active W-2 income. There's a lot of benefits being at play there. It might not be advantageous for someone who is not a real estate professional. So I think that is just really important to kind of understand those before you go down this path.
Mm-hmm. And that goes back to the passive versus active.
Mm-hmm.
Something I totally agree with there. And, since I did my cost seg studies last year, I built out like a small template and kind of did a couple like tables just showing some of the breakdown. That's, it was for me to understand the numbers. And I was like, oh, other people the same information. Let me copy paste it to, prospective clients. And one of the big questions I've gotten, and I had this myself, was well, if I take all this depreciation, that would be straight lined over, 27 and a half years and front load it, am I going to shoot myself in the foot, down the road? And I don't have my numbers in front of me, but like the difference between after that first year where you get that massive loss, the massive phantom loss, and the difference between like year 2, 3, year 27 on a non-depreciation or a non-cost seg schedule or the cost seg schedule. And since you front load it, it does remove depreciation from the future. It was so minimal. I mean, a lot of times it was like $2,000 or $3,000. You're going from like an $18,000 year example to $15,000 a year. And as I ran the numbers, I was like, wow, in year 10, I don't really care about a $3,000 difference, or especially in year 20, because it's a future dollar. And we all know future dollars worth less than today. Plus, I'm like, there's a good chance I won't own the property anymore either. So I found that fascinating. And I was really pleasantly surprised with what small impact that had on just even that long-term depreciation too. Because even still after I get that big front load, the next year I still want a lot of depreciation to help me lower my tax basis. And it was a very, very marginal difference in my experience. Is that common across, I mean, you've done way more than I have. Is that a common theme across cost seg and bonus depreciation?
Yes. And when I do an estimate, I also include what it's going to look like down the road. So you can see how that amount of depreciation is. There's still depreciation there ongoing because the structure of the building is going to depreciate over the 27 and a half or 39 years, even if you take this bonus depreciation up front. So there's still depreciation. But, I want to say one thing that I think is really important here. And a quote that I absolutely love was done by Robert Kiyosaki. And he said, the most important word in the world of money is cash flow. The second most important word is leverage. That's what you're doing with cost segregation. Because if you invest the money that you're not paying in taxes that first year that you get it in bonus depreciation, if you reinvest that, even if you're a business or whether you're investing in real estate, you can usually expect about 8% appreciation a year, right? Isn't that what you experienced, Chris?
Did you say about 8%?
Mm-hmm.
It's a little higher than we underwrite, but
Really? Okay.
Yeah.
Well, yeah. So, with the, in Colorado, we've seen appreciation on properties.
Oh, I'm sorry. You said appreciation. I thought you said
Appreciation.
depreciation. I was like, oh, I haven't done that mental math. Oh, appreciation.
No,
Okay.
appreciation. If I said otherwise, I'm sorry.
No, I think that was just, I'm in depreciation mindset. And those two words are too similar.
Yeah. So you can expect about 8% appreciation, on what you're getting up front, because our tax rates are going up. You can use that money now. It's worth more than down the road. So leverage it by reinvesting it in something, whether it's a business that's not W-2, like the doctor's wife, who can do that, put it in another property. Why not? I mean, you're going to get more. You let it set with the Treasury Department. They're not giving you interest on that.
Mm-mm.
No.
Yeah, that is that's my strategy theory right now. I've not executed yet because I just got my taxes finalized a few weeks ago. Mm-hmm. But hey, if you can take a lot of that refund you get, reinvest it, it's not quite enough to cover another down payment, especially now in the higher interest rate environment.
Sure.
But man, it covers a significant part of, a down payment or some other investment. And if you can kind of keep that flywheel going to use it to leverage up again, and then buy another asset to help create more, bonus and cost seg depreciation. Like, I haven't the numbers, but like mentally, that's an awesome flywheel.
It really is. And so, another thing I want to mention before I forget it is a lot of your investors on Bigger Pockets are smaller investors. They're getting started, right?
Yep.
And I've seen some of them that say, well, I'm living in the basement. Remember, I just got one of these recently. The basement is X number of square feet, but the rest of the house, I'm leasing long-term. and then I'm going to sell that and flip it. Can I still do cost seg on that? The answer is yes. Because the percentage you are living in is removed because you can't depreciate that, but the rest of the house can be depreciated. If it's a short-term rental, the rest of that house can be done on the 39 years depreciation. Okay. If it's a long-term rental, so 30 days or more, which most of them are, okay, then you've got 27 and a half years of depreciation. Both of those can be expedited with cost segregation up front the first year. That gives you more money than to be able to invest in the next property and maybe move out of your basement and get a different place. So there are a lot of little things that people are not aware of that can help them get to that next property investment, even if they're just starting out.
And that's why, like, as we start wrapping this podcast and always trying to give like actionable items to our listeners, like, I mean, I was able to follow with everything that you explained today. I think it's because I've been, learning about this last probably 3 years now. I really started studying it. Like I said, it took me a while to understand it. So I expect a lot of our listeners out there, they grasp the concept, probably hazy on quite a few details, which is normal and fine. But what I did, I mean, I recommend this to everyone. You can correct me if I'm wrong. Is like, hey, if you have a property, you like the idea, don't go into like deep analysis mode. Go reach out to you. Go get a free estimate. Go circle around with their tax professional, understand what impact it may or may not have on their taxes and all the ancillary stuff. And I think those two steps probably is like the best action steps that I recommend to my clients as I talk to them. I'm curious, like, what you'd recommend to investors out there.
Yes. Yeah.
Okay.
Learn about that too. I mean, obviously they're looking at, what is the price of the property and what do the numbers look like? But too many of them forget to look at, okay, what about other benefits that I have with investing in this property? And it can really make a big difference in how fast you can grow your business.
Yeah.
Cool.
Bonnie, I wanted to ask Chris, do you mind if I ask a kind of a we can end the barrage of questions on a complicated question, if that's okay. So in Chris's example before, he mentioned the front loading of the depreciation, the accelerated depreciation. Say he does sell in year 10 and he doesn't want to pay depreciation recapture. So he does a 1031 to defer those capital gains. What happens then? Can he then 1031 or can he cost seg his property that he 1031s into? Can you give a little bit of an example on that?
Sure. Let me try and make this quick. There's a little complexity to 1031s. There are two aspects. One is the relinquished property. If you've done a lot of repairs on that relinquished property, you want to do what's called a depreciation schedule scrubbing. A lot of the things that you did now can be expensed rather than capitalized. So you want to get those off that depreciation schedule for the old property, the relinquished property, before you do that 1031 exchange, because then it'll lower the basis going into the new property. Now, you can do a cost segregation on the new property on the 1031, as well as even if you've done it on the previous property. It's just that you want to make sure the difference between what you're selling the old property for and what you're buying the new property for, the new basis is significant enough difference so that you can take cost segregation again. So you can do it the next time around. It's just that we can't segregate a property or the amount that you deferred from the relinquished property the second time. We can only depreciate the difference between that and what you bought the new property for. And I know that's a little bit complicated, but I can answer those individually if someone has a question. Our consulting is free of charge because we want you to be educated. Okay. There's another aspect of this, and I think, Jenny, you mentioned this earlier. If in your later years in life, I have a few gray hairs, but not there yet. Okay. If you are willing your property, you're not going to sell it. You're going to will it to your children. Okay. Do cost segregation now, because you can take that money, reinvest it wherever you want. You can pay for your kids' grandkids' education. You can, whatever you want to do, that take a trip, use it now. When you die, that property is transferred to your heirs at the current market value, which means your heirs can do a cost segregation as well. So there's a benefit there. So just because you're going to will it to your kids does not mean you shouldn't do a cost seg. Actually, you should, because there's no recapture. No recapture at all if you will it.
I think that piece alone is just phenomenal. That's pretty incredible piece of information.
Oh yeah, I think it's great. So Bonnie, how can people reach out to you to either, have a consultation and or get a free estimate on their portfolio or a property they own?
They can email me at Bonnie, BONNIE, G as in girl, K as in kilo, at costsegregationservices.com. Or for your podcasters, I would even love getting a call on my cell phone. Is perfectly fine. My cell is 303-475-4459. If I don't answer, I'm probably on a call with somebody else or on an appointment. But you can also leave me a message either there or on my office line at 720-504-5776.
Fantastic. And we'll make sure all those, the email and the phone numbers in the show notes as well, since a lot of times people are driving. Everyone reach out or check the show notes so you can reach out to Bonnie. For some reason you have trouble finding them, reach out to me or Jenny. We are happy to connect you as well. But Bonnie, this is fantastic. Thank you. You obviously are an expert in this field. I learned a couple new things today, which is always one of my goals on the podcast, is get to interview experts. I want to walk away with one nugget. I got a few nuggets as well. So thank you. And I highly encourage all of our investors out there to get very familiar with depreciation in general. It's a very powerful wealth building tool. And then start layering on and understanding the cost segregations, the bonus depreciation, accelerated depreciation, the real estate professional status. Understand that, because as your investing career evolves or as you buy different types of properties or asset classes, you can see there's a lot of nuances on there, but there's oftentimes ways you can go out there and use depreciation and create a lot of cash flow today, which just helps accelerate the flywheel for more wealth creation as you reinvest the money. So love the topic. Love your expertise. Thank you so much, Bonnie.
Thank you.
Thanks, Bonnie.
Thank you for having me. It's a pleasure.